joining, everyone. We've got a few people I'm sure will join as we go. But the purpose of tonight is to talk through how to present projects to lenders to give yourself the best chance of getting the right funding. So we'll start now. Just a few things before we start. If you put your questions in the Q&A at any time, we'll answer them all at the end. So Tim and I will stay on for as long as you need to answer all of those. We are recording this as well. So if you don't like that, then you'll have to leave, unfortunately. Who we are. There's a bit about me. There's a bit about Tim. So primarily I've come from a broker background. I've also been a property developer, or still am, I guess. I guess you never stop being one. And so the way I came at Brickflow was I found that it was extremely difficult to find the right deal. And by that I mean that there's so many lenders out there. Everyone's got different criteria. And it's very difficult to know that you're getting the best deal. And that's even for someone that was in the market. When I did my first development, I'd been a broker for 10 years in this space, and I still didn't know I had the best deal. And I just thought that was crazy. And so what I set out to do was index all of the criteria for all of these lenders. And then over the years, we've automated it and turned it into a search engine / comparison site to help other people make sure they find the right finance. Tim, I'm sure will introduce himself, but he has a lending background. Tim?
Yeah, so I've been funding developers as a lender for many years, and Ian worked with me at my last bank where he was introducing business to us. And when I decided to have a career move about a year or just over a year ago, Ian asked if I would help take the lender's perspective on matters. So that's where I am. I have been funding developments all over the UK, and I know, as it says on there, the frustrations that borrowers have. I also know the frustrations that lenders have, and most of tonight is about how you can make the lender's life a lot easier and hopefully get your application to the top of his pile.
Cool. So that's a bit about us. So as we've touched on, our core reason is to help developers do more with less. And what we mean by that is we want to eliminate inefficient equity deployment. So the majority of people, when they operate in this space, will always put more deposit in than they need to, or they'll be paying a higher rate than they need to. And that's simply because there's not the transparency that you need in the market. So the difference here with the types of loans we're talking about, I mean, at a sort of minimum, they're hundreds of thousands of pounds, but quite often they're millions of pounds. So differences in rates and differences in percentages of upfront deposit can translate normally to hundreds of thousands of pounds in savings. So this is not like when I talk about when my mum used to 25 years ago sit at the kitchen table once a year and spend half a day ringing around car insurance companies to save herself 20 quid. We're talking about life-changing amounts of money normally. So it's very important to get the right funding. There are still, unfortunately, some bad apples out there, less than there used to be. But there are some bad actors in this space. So you need to know who you're dealing with. You need to know that they have the funding to fulfill their pipeline, and you also need to know that their contracts are not going to be something that sort of scuppers you in the future if something goes wrong. So making it our whole sort of thinking behind making it easier for lenders to find loans, which is what we're doing here, we're connecting borrowers and lenders, is that it should make development finance cheaper. If a lender can source the right deals and not spend the hours and weeks that it normally takes them, then hopefully that they become more efficient, they can decrease their cost of development funding, And that's good for everyone, because that means that as costs drop, marginal sites become profitable. And it also means that more houses get built. So that's where we're coming at it from really here, is for developers, for brokers, for any other stakeholders, lenders as well, obviously, for any other advisors in this space. If they can be more efficient, then that's only going to be to everyone's benefit. So what we'll cover today, so conversion rates from development lenders is very low, from inquiry to loan completion. So we're seeing why that is, and why what you can do to improve your chances of success. So why are conversion rates so low? So 1 in 25 inquiries becomes a loan. That's what lenders tell us. So one of the questions we asked when we onboarded all the lenders onto Brickflow in the early stages, so we've got 37 lenders on today. And one of the questions we always asked was, how many inquiries do you get for each loan you complete? And the answers were wide and varied, and some were slightly tongue in cheek, I think, because there was sort of 1 in 50, 1 in 100 was mentioned by some people. But I think the general consensus was around 1 in 25. So that's 4% of inquiries go through to completion. So you can imagine, as somebody that sits on the front side of a lending business, that their day is filled knowing that the majority of stuff, 96% of stuff they're looking at, is not actually going to complete. So, they're human beings after all. Which ones are they going to concentrate on? And that's what we're going to look at today. But the reasons they are so low are twofold. Lenders don't publish their criteria. So this means that borrowers have perhaps a preconception, misconception, what the lender might be able to offer. And the lender can't always match that conception. So they end up not being able to be competitive or offer the size of loan that the borrower wants. The second big reason is bad presentation of information. So you can imagine, as we've just touched on, as a lender, if you've got 25 inquiries in your inbox, and 24 of them are probably not going to end up going anywhere, you're going to concentrate on the ones that have given you the right information in a nice format, because that's the path of least resistance for you. So there is no central database for borrowers or brokers to compare lenders. We're obviously trying to do that. So that's something that is helping the market. Borrowers and brokers tend to approach lenders blind. So there's limited criteria that lenders will publish. There's so many little nuances and criteria. So we say in the bottom bullet there, we collect 121 different data points from each lender. Most people you would speak to in the space on the borrower side probably be surprised that there's that many different data points that can be collected. But these are all things that lenders are looking at, and there's other things that we don't even collect internally that lenders will be monitoring that we will never be privy to. So there's a lot of information that's needed to calculate your loan, and any one of those, every single one of those bits of data is going to be different for every lender, and that will have an impact on the amount you can borrow and the cost of that loan. As we said in the third bullet, it's impossible for a human to retain all of this key data. So Tim, bless him, is in charge of all of this information. So it's nearly 4,500 bits of information sit in our algorithm that then sorts which lenders should be available to you. So as you kind of touched on already, lenders will concentrate on projects that have been presented correctly. Every lender prices differently. Criteria nuances means huge differences, and we can see that on the platform a bit later on. As we said as well, there will be things within internally within the lender which we'll never be privy to as to why they might not fund your deal. So this is an example which, believe it or not, happens. Tim and I were with United Trust Bank about a few weeks ago, and they said in the meeting, one of the guys in the meeting got an email while we were in this meeting, and basically said this is what he received from somebody. He'd been blind copied in, so he knew straight away it'd been sent to 25 probably different lenders, maybe 5, 10. But when you receive this, you just hit delete as a lender. There's no way that any lender is really going to give that any time of day. Tim, how often did this happen?
Yeah, the leading question from a number of brokers, I would say, not necessarily direct clients, it was the broker market that I was active in, and price to them was the first matrix, the first key point for any deal. What do you charge? You hadn't even got the deal, you hadn't even got the area, you hadn't even got the experience. What do you charge for development finance? And how can you price when you don't know all the details? So it wasn't rare to get one of these type of emails or a phone call, and you just say, you ask the guy where the property is, go, oh, I don't know. That type of approach, it was very, very common. Where's the property? Oh, I don't know. Is it relevant? Yes, it bloody is. Then you want me to quote a rate. So no, it's very, very common.
Okay, so we're now going to walk through what's most important to a lender. So Tim used to be a lender, as we've said. So
still am.
Yeah, in your head you are, yeah. So experience, you said, is probably the most important thing you used to look for as a lender.
I mean, the experience is going to get you out. Has the guy built? He's come to you. He's done a flat conversion. He's now building a 30-story tower block. Yes, he's a builder, but it's not experience. We're looking for direct, relevant experience. Have you done something like this before? Is it just a gradual move up from doing an extension, a loft conversion, to doing, a pair of houses? It's relevant. What was your last deal? What was your last deal before that? Is it a gradual progression, or are you taking on more than you can? And that second line says, if you haven't got the experience, who has? Somebody wants to know about who in your team has got that experience that will give comfort to the lender.
Yeah, I mean, the experience is, there's loads of different ways of structuring this. If you haven't got the experience, doesn't mean that it's a no. Permitted development is a great way to get into development, because it definitely carries less risk for a lender. So there's definitely opportunities there. New build, generally, you're going to need experience. So you either want to have you're either a construction professional that's now become a developer, or you're going to have somebody in your team as a shareholder, or directly profiting from the scheme itself. So the way that you can sometimes do that is tie in a project manager or a contractor on a profit share basis to allow them to share their experience, basically to leverage their experience to satisfy a lender. If you have any questions on that, just call us and we can talk you through that. Location, Tim.
Yeah, again, location. We've got lenders that lend all over the UK, and the search engine that we provide enables you to click on counties or districts of the UK. There are a number of the small lenders that won't go too far, won't go beyond. Everyone used to say in the old days, the world stops at Bristol. A number of lenders used to give up at Devon and Cornwall. But then we've got, regional lenders, one based in Wales, would be happy to go there. It's around the corner from them. So one of my first banks I went to, the manager said, or the owner of the bank said, I want to be able to get there and back by lunchtime. Well, that meant M25 home counties. So everyone's different. We've seen the explosion of regional offices, with most of the lenders and the bigger names having regional offices. Location's not a problem, but it might be. And I was at Paragon before I joined Brickflow, and Paragon would not only look at the general location, they would look at the postcode and would look at the indices for which postcode was driving the best growth. So very focused on location.
Yeah, and as you said there, did I have exposure then? So that's not something you're ever going to get from the lender. It's impossible for us to know what their book is, but
Yeah.
every lender is always going to be mindful of exposure to a certain postcode.
Yeah, there was just anecdotally that also that was big. There was an explosion of new business driving Croydon, Purley, Coulsdon, Kenley. Everybody was getting a knock down a house, put up 11 flats, or because it was just under the requirements. And it got so bad that our credit committee said, we're full on that postcode, we're full on that district. They could have done everything in the whole of London, but Croydon, Purley, no more until we've sold something, because we've got high exposure.
The other thing as well is that lenders will do a search on other planning applications in that area. So, it's not even just their own exposure; it's what else is coming.
Or resales. What is sold in that area.
But I'm talking more like if Barratt or Galliard have got a 400 unit scheme being built just down the road from you, and you're going to build something that's smaller but at a higher price point, then that they're going to be nervous about that, right?
Yeah, so, coming to the market at the same time.
Yeah, exactly. So they want to know what's in the pipeline in the area and how that's going to potentially impact your scheme. Professional team, Tim.
Yeah, well, we sort of talked about it earlier. The relevant experience. If you haven't got sales experience, a lot of builders can build houses, but they've got no idea how to dress them, how to market them. That's a skill. Have you employed? Some people employ people to do that before they even design the house, so that they've got the right layouts. But in terms of architects, project managers, structural engineers, the more the better. Obviously, the small deals, you couldn't afford to have all these people. But the larger the schemes, the lender is going to want to see that you have taken advice and filled the gaps in your own shortfall of knowledge.
And contractor financial strength is a big thing at the moment. So every lender's really hot on this. They will do due diligence on your contractor. So if you haven't, they will. But it's always good to be ahead of the lender on these things, because if you put forward a contractor that a company's house is sort of in the red and looks like they're going to go under sometime soon, then that straight away undermines your credibility, because you haven't done your own due diligence. So I saw a stat a little while ago that 16% of all insolvencies at the moment in the construction industry, which is just nuts. So lenders, every lender that you speak to will almost certainly have a contractor that's gone under on a deal on their books at the moment, and probably more than one. So they are very hot on that. So do not get caught out by that. Okay, next, we've got percentages. Deal analysis, Tim.
Yeah, so we're talking about does the scheme make sense? A lot of developers I'm talking to at the moment say they can't buy sites because the prices that are being asked or the prices that are being offered just don't make a profit, and they can't understand people investing in property, which makes minimal return. The old dyed-in-the-wool developers would be looking for 25 to 30% return on cost pre-finance. If you're building to hold, building to rent, you may take 10 to 15. The profit is, you're not looking for profit. Obviously, you want to cover your costs and make a nominal profit, but your ultimate end game is to get an income. So, but minimum return on cost, it's normally 15 to 20% after finance lenders are looking for. And the loan to GDV, well, that just is going to drive which lender will focus, because we've got lenders offering 55% of GDV up to 75% GDV. What we don't have is 100% finance. So loan to cost is big as well. And we'll probably talk about it later about how all of those percentages play against each other. You can have someone doing a high loan to cost, but they won't go more than X loan to GDV. So whilst they say they'll do 90% of cost, you'll never get there because they're capped at 60% GDV. and mathematically it never hits those buffers. So the matrix on Brickflow will show you exactly what each lender's terms will give you by way of a deal, and it will show you how much equity you will need to put into that deal with that lender.
Profitability is also quite regionalized. So you'll find that, perhaps in London, Southeast, lenders will accept a lower figure than perhaps in more regional developments. How much equity does a borrower have in? I mean, that's key, that's crucial. Every lender will want to see you have some skin in the game. But most developers will be borrowing some of that money from investors. And every lender has a different view on that. Again, we publish all of that information on the platform, so you can see that, which helps with lender selection, because that's not something lenders publish. Loan size, Tim, why was this important to you?
Well, if you've got 8 hours in a day and you've got a target, you're not going to be doing 250 grand loans. You're going to be looking for the £5 million loan. We actually say it takes longer to do a small loan than it does a large loan. The large loans are more efficient. You've got more professional people behind it. You're not quibbling over costs. You know exactly what your fees are going to be. You've either got the money or you haven't. You deal with a guy that's borrowing £500,000. He's running his credit lines. He's playing his sales. He's taking lines of credit. He is not aware of what a valuation will cost, what a QS monitoring surveyor's fees will be, and they get out of kilter. So in terms of a lender's perspective on loan size, he would like to do the larger loans, of course. We've got plenty of lenders on our panel that on the Brickflow website that don't lend large amounts. They start at 150,000. They might go to £1 million or 2 million. We've got a lot of lenders, or some more lenders, that go from 2 million upwards. So it's not a problem if you've got a small loan. There are lenders on our platform that will support you. But if you are a lender with a big target, you're going to want a big loan.
Okay, so it's basically time spent versus return, really. So you almost, for those smaller loans, you want them to be more organized, right? You want them to be more prepared. Okay, end property type.
Yeah, the end property type is important for a lot of lenders. There's an aversion to high value gin palaces, the Wentworth estate, the West End properties, the massive pound per square foot Knightsbridge properties. Don't get me wrong, we've got lenders who love them, but equally they're not family homes. They're not. They take one specific buyer. It's got to be designed exactly with that buyer in mind. We've just lost the Russian market, and don't get me wrong, it's not one I don't mind missing, but the Russian market, the Italian market, the Chinese market, Japanese market, they've all got different types. So most lenders want to do, I'm not saying run of the mill, but affordable, maybe first time buyers, maybe. They've all been doing the help to buy until that sort of narrowed down to first time buyers only. But equally, a family house will have a much wider market than a bespoke house, and therefore it's likely to sell quicker. That's why they set their policies. They want to do the majority of their properties, lend to the majority of developers who are building properties that appeal to the wider market, because they can get quicker repayment and do more business.
It's liquidity, isn't it? Ultimately, they want the.
Well, if you've got a £5 million house and it's taking longer to sell, the interest cost on that loan is rolling up and rolling up. It soon eats away, and that's
if you've
quite a scary number. 10
£500,000 houses, you're selling one a month or one every couple of weeks, then it's kind of chipping away. Yeah. Comps.
Yeah, so I said earlier that a lot of the lenders do what we do: Google searches, Rightmove, Zoopla, whatever. What's sold in this street? What did they go for? What is a 3-bedroom house? I've got one at the moment I'm looking at in Essex, where it's a semi, quite quite a high value property. And one of the lenders came back to me and said, well, I know he's asking X, he's thinking of selling these for X, but we can get detached houses for that. Why does he think his semi is going to get the same price as a detached house in the same postcode? So we asked the borrowers to provide comparable evidence, speak to local agents, get 2 or 3 letters from agents saying, love your scheme, right location, you're definitely going to get 750 to 800, 1,000 a unit. Put that with your deal. It shows you've done your research. It shows support. But lenders don't know every postcode. They do rely on local agents, as do valuers. So get the agents to do the work first, put it in. The agents are delighted to do that for nothing because they think they're going to get the sale out of you. So it costs you nothing. Letter of support goes a long way.
We really push people to do this on every application, simply for the reasons that Tim said. But also, I think you're going to learn a lot from agents. You know, they'll know other schemes in the area, why they sold, why they didn't sell, you know, what was received well by the market. So, you know, there's a huge amount of information that's held in each of those conversations. So definitely do that as much as you can. The other thing as well that I remember a lender once telling me is that comps was the longest part of their job. You know, if they could make an assessment of a scheme relatively quickly if it was laid out, but actually the comps was the biggest part of their job. If you've got comps in your presentation to them and you've identified if they're good comps or bad comps, so as an example, you know, road further away, exactly the same sort of square footage, but you might be higher in terms of elevation, so you're overlooking a valley, they're backing onto a valley and they're north facing. You know, all of these things, that would mean that your comp is that's not a good comp because your product is superior. So, you know, you're not going to get that necessarily from Google Maps and without local knowledge. So, you know, I really spell it out for them. The other thing you can do here as well is a desktop survey. So if it's a big scheme or, you know, perhaps is a bit unique, but you know, valuers believe in it in the area, it's always good to get a desktop. It's going to cost you a few £100, but to go to a lender with a Savills or a Knight Frank or Struts or someone like that that's already said, yeah, this is a good scheme, demand's high, will help you get through the door. Assets and liabilities.
Yeah, so first-time developers trying to raise as much as they can. They're always going to be asked to give a personal guarantee to support a company borrowing. The lender is not looking to take additional security. They're just making sure this is a sort of it's a liability, but it's a liability that borrowers sometimes don't understand. Is the banker looking, or the lender is looking for the borrower to cover or put in further cash if there is a cost overrun? It's pretty standard, because if they don't, then the lender will have to. So what is in the background? Does the guy just own his own house? It's in his joint names with him and his wife. He's mortgaged up to the hill. He needs to find another 50,000 to finish the project. He's not going to be able to do that. So the lenders want to know whether that's realistic or not. If it's not, then maybe they won't lend 65, 70% GDV. Maybe they'll lend 55, 60, and knowing that at some point they may have to increase it and still be within policy. But people with portfolios, investment properties, it all adds. I know that one lender we deal with specifically wants to see 200% cover on the guarantee from assets, and they will look at those assets and they will check what those properties are, just to get an idea and verify that the assets and liabilities are factually correct. So what ability does the borrower have to put more money in at the end? He's given a guarantee that he can, but can he actually, if push came to shove, could he put his hands on another 50 grand or not? And that's the stronger the asset and liability position, the easier it is for the lender to move on. And a lot of this application business is about ticking the box and moving on. If you get stuck on any, one bad answer or one light area won't kill the deal, but you start getting doubts across these points, and they all add up to a negative picture.
Exit strategy.
an easier one to explain. Exit strategy. You know, are you, as I said earlier, are you building these to rent out? You're a landlord. You've done a bit of development. You can't get the stock in the market. You know what? I'll buy something. I'll convert it. I'll buy a plot. I'll build a house. So, are you going to refinance it? Can it be refinanced at the level you're borrowing to develop it? You know, if you're borrowing 70% GDV on to build it, can you get 70% GDV mortgage, buy-to-let mortgage? If you're selling it, when are you going to start marketing it? Are you going to sell marketing off plan? Or are you going to wait until it's completely finished, grass has grown, daffodils are out, and then put it on the market? What's your strategy? Have you tested it? What do your agents say you should do? Are you know, when will these hit the market? Are they going to hit the market in the spring, or are they going to hit the market in the winter? And if the market falls, could you refinance it? Could you turn it into an investment in the short term? So
sales is always best, right? That's,
yeah, sales is easiest.
Prefer sales
because you could quit if you can out these, if you can sell them, you get your cash back, move on. If you've got to refinance it, you've got to go through the lending process again. Takes a bit longer, and as I said, you've got to find a lender prepared to lend you as much or more than you're already borrowing. So
well, if you've got 20 units, you need to sell 13, 14 to repay the lender. If you're refinancing, you've got to refinance. You've got to do 20 mortgage applications.
Yeah,
you've got to have 20 tenants.
And an important part there, if you have got 10 flats and your exit route is refinance, when you refinance at 75% loan to value, the lender probably wants you to do them all at once, because otherwise it's going to lose 25% of its security value every time you refinance one unit. So it might not let you refinance one at a time.
The other thing as well, when you refinance a block, is that normally there'll be a discount applied by the valuer, because it'll still be a one freehold title. So they might haircut the value by 10, 15%, in which case 75% of 85% of the open market value is probably less than what you owe the lender. And
then you got the lenders who want 10 different leases, or a lender that wants one freehold. There's so many aspects there as well.
Okay, supporting documents.
Yeah, so ultimately this is all of the above. You know, what have you got to support this? We bring together in the Brickflow application as much supporting information as we can for the lender to say, you know what, I've got everything I need here. I can make an instant decision. So whether that's the planning application, the planning decision notice, the design and access statement, the drawings,
that's
the
my favorite.
Yeah, sorry.
The design and access is my favorite, I think.
Yeah,
document to include.
Yeah, you won't generally have that for smaller loans and smaller developments, but you will have it for a medium to large scheme. But that has got so much information in there. Background to the borrower, previous experience, background to the contractor you're going to use, again, previous experience, website links to the contractor, website links to your professional team, anything you can put in there. The asset and liability statement we gather, and we would like to pinpoint the location, the site layout, the floor plans, very important. You know, I've had one guy, or one lender's credit committee said to me, appreciate these are 3-bed flats, but you've got to walk through the second bed to get the third bed. You know, that's not a 3-bed flat. And I hadn't even thought of that. But he's looking at that much detail because he's got so much, he's starting to find fault in things that he shouldn't even be looking at. So that get it all lined up.
But it's certainly, if it had got through credit, it would have got found out at valuation stage, right? It's
fair play to the guy.
Good to get these things out in the open. That's an interesting one. I think you have to fill me in on that one. Sensitivity and analysis.
Yeah, the what ifs really. A decent development appraisal model will have, as we say on there, GDV falling 5, 10, 15, 20%, build cost rising 5, 10, 20%. Cross-reference those, you've got GDV falling 10%, build cost rising 10%. Suddenly your 20% profit becomes 10% profit. still get out, but
It's a lot finer.
no, yeah, it is, but it shows that you've thought about it, and this is what we're talking about today. You have looked at every angle, and you've still covered, and you've got those risks covered off.
Yeah, yeah. Timescales.
So I had one the other day. He was buying at auction, he thinks he was buying at auction. He was going to try and bid at auction. If he was successful, he had 28 days to buy the roof space of a block of flats, get a contractor, because he'd never done roof space before, get a contractor, get a structural survey, get a valuation, get the legals, and get a credit decision in 28 days. There's no lender in this world that would have done that on airspace. They could have done a straight bridge on a property that existed, but not on airspace. And he said, you're right. Basically, if the guy has exchanged contracts, we've had him in, but the guy's exchanged contracts, he's on notice to complete. You know, you've run your 28 days. You're now on borrowed time. Can this lender deliver in the statutory 10 working days? They're the extremes, but typically the borrower, the best deals the lender can see is the borrower owns the property, he's got time on his hands, he's paid cash for it, he's just looking to restructure it, raise some finance and build it out. Brilliant. But don't come to me and say, I've got to complete yesterday. Lenders are notoriously, I say lazy because I'm a lender, but they are notoriously fickle on timescales. And you try and get a valuation over Christmas. It's never going to happen. You try and complete the week before Christmas, never going to happen. Solicitors, surveyors, lenders, MS, all go on holiday. So different times of the year, different things happen. Make sure that the lender can deliver, and I want a lender to say no. I don't want a lender to say maybe and then drive us up the wall. Yeah. We've had some, haven't we? And
I mean, there's a couple of things there. If you haven't got a tight time scale, then normally you complete on a bridge. Most development lenders will actually do bridging as well. So you can complete on the bridge, and then you can change lenders if you want, but it's normally more efficient to identify the development lender you want to work with, ask them for a bridging facility. So we don't have to do the build cost analysis. We don't need a QS report. We just have a residual land valuation, and the lender will lend against that value. And then when the time is right, then we convert into a development loan. So, you know, a QS, I saw today we were getting some quotes for people on valuation, and it was going to be 3 weeks, I think some valuers said, before they would be able to even go and inspect the site. And then they were giving themselves up to another 10 days to turn it around. So that's five weeks from now, just to get a valuation report. Then the QS has got to do their bit, the lawyers have got to do their bit. So you know, there's
the valuer can't do his report until he's got the QS analysis on the build cost. He can only take his guide, and he'll still want to see the reports at the end of it and reconfirm. Same with the QS. It is too difficult sometimes.
Yeah, certainly on the development finance. I mean, we have done them in sort of 4, 5, 6 weeks before, but I think that's, as Tim said, that's where somebody owns the site, has everything in position, and is just pushing forward to get the loan, start the construction. Are they hiding anything?
So yeah, Google search, amazing. Say I can only quote on what my experience, but nowadays, if anyone I've not heard of, first thing I do, either LinkedIn, Companies House, Google. If you put the name in, up comes Fred Blogs. Did you know? If I can do it, the lender can do it, you can't hide in this world. With the internet, just brings everything out. So if you've got one I'm doing at the moment, the contractor did a voluntary CVL, corporate voluntary liquidation, 4 years ago, 5 years ago. I said, he said, then one lender found out and didn't like it. I said, why didn't you tell him? He said, well, I didn't think he'd notice. You know, they do notice that if you do a Companies House search, they will drill down past performance, and it's there. It's a matter of public record. Google searches is easy. Everyone does it, and it's there. It's the information is there for the taking. So if they can do it, you should do it. Come clean up front, and don't expect to get away with it, because it will make you look worse, not better. So do make sure you're telling the truth, and make sure you're telling it not warts and all, because there are ways of dressing it up, and I have gone to the dark side of broking now, but they don't want to know that you're an ex-bankrupt.
Yeah, I think point there is that development lenders generally are a lot more tolerant than high street lenders for, say, a residential mortgage. So if
you got into trouble in the 2008 crash, 2009 receiver appointed, 2010 bankrupts, that's it. That I'm not saying it's acceptable, but it was, and there were a lot of developers who lost a lot of money. Companies went bust. That's say normal. If you did that, in 2005-6, there must have been something wrong with you. No one lost money in 2006. So that's what it's about.
Yeah, but as I say, lenders are a lot more tolerant of misdemeanors, and as long as there is a explanation, they'll normally be okay. They'll find a way around it. The worst thing that you can do is try and hide something and it comes out at a later stage, because lenders will then just get annoyed with you and either rack their rate up or just refuse to lend to you.
Yeah, or find another. That'll then compound with something that was marginal. Suddenly it becomes make or break.
Catastrophic, yeah. So yeah, just get things out there, and lender will either say yes or no, but it just saves a lot of everybody's time and aggravation. Okay, so how can you improve your chances? Right, so check viability first on Brickflow. Okay, so what we're talking about there is your project itself. Be targeted with lenders, so check eligibility and build a project appraisal that stands out. So I'm just going to switch screens quickly, and let's do that quickly. I should be here. Okay, so this is the platform. So let's say we're buying a property for £1 million. We keep the numbers nice and simple. We put our purchase costs in here, 30,000, and then I've got my property location. Let's say it's in the Midlands. It's new build, end property type. I've got all my commercial property types here. I've got mixed use, then I've got residential. Let's say this one's resi. Let's say I'm building some houses. And let's say I'm building, 30 houses. Okay, my build costs, let's say 4 million. My contingency is already there for me. I can make it higher if I want. 30 houses, let's say it's 30,000 square feet. So that's my build cost per square foot. Professional costs and charges, that's anything that is not a core construction cost. So ordinarily, that's going to be about 10% of that core construction cost number. Okay, so I've got my total build cost down here, 4.7 now. My GDV, so let's say £8 million. Okay, if I have a loan amount in mind, then I can put it there. If I want the maximum, I just leave things there. I can change the build term, loan term if I want. Might be a little bit shy for a 30 unit scheme, so let's just change that a little bit. And then I hit search loans. Okay, so we've got 28 different loan options that have popped up there, and you'll see that we put these lenders in order of who's going to lend the biggest amount of money. Okay, so you've got deposit size here. You've also got lender costs. You've got your profit, and you've got the land loan. You've got the build loan, which will always be 100% funded first, and then whatever's left over is your land loan. So let's play about with this a little bit. For instance, so let's say our land cost actually jumps up to 1.5 million. So then you can see what my deposit is and my profits changed. Okay, so this is now becoming, perhaps a more marginal deal. If I was being asked to pay 1.8 million for this scheme, then I'm now having to put in 1.5 million, and I'm making only, but I'm making 800,000 of profit. Okay, Let's say my build costs move as well. And I go out to tender. I've now got 4.3 million of build costs. So again, everything changes. So you can start to see here where deals are viable. Yeah. You want to be aiming really for anything above 50% on return on capital employed. If you can get above 100%, that's a very good deal. But you can start to see, where your costs need to be for the scheme to be viable. I always say to people, if this number is right and this number's right, then this is the number you need to change. Okay. If this deal is not profitable enough, then you're being asked to pay too much for that, because this is almost fixed. Once you've been out to tender, you know you can build it for that price. That's not really going to change. It might even go up, right? GDV, I mean, market is high, but it's certainly not ramping up in the near future. So that's not going to change much. So this is the number that you need to change. And as everyone always says, with every development deal, the profit is in the ground. That's where you make your profit, is by buying at the right price. So for something like this, where you can put in circa $1 million and make $1 million, that's probably where you want to be. So that might be what you pay for that site. Check eligibility. So then what you want to do is go through how each lender actually looks at you as a borrower. Okay, so the information there, which is really useful, use the interest rate. How will the interest rate change during the term of loan? So this one's linked to base rate, level of personal guarantee 20%. They will consider 20% of total deposit from shareholders, 75% from investors. So back to our screen, they want a deposit of £1 million. So 250 from you, 750 from investors might be possible. Yeah. So that's useful information. Would I accept charges over other property instead of cash? So got buy-to-let portfolio with low mortgages on. Could be that you do that instead of remortgaging. Will they lend to individuals, companies? Would they ever lend to first-time developers? Yes, subject to a good scheme. Permitted development rights, good team, sorry, yeah. Permitted development rights, yes. Air rights, yes. Listed buildings, modular construction. So all that information's all there for you. And let's say I meet all of that criteria, I shortlist. Then I do the same again with this one. And I know I qualify. So I've got these three lenders. I then go through to our project appraisal part of the platform. And I start building out my project appraisal. It's been a bit slow. And these are the four main modules that you need to complete. So you've got a case overview here, which is ownership of the property. Name and company. You add your shareholders, where the site is. Did you buy it with was it regular purchase? Was it an option? Planning. Who got the planning? Was it you? Was it the person who owns it at the moment? Give us a bit of history on the planning. Build procurement. How are you going to build? Design and build, traditional contract, self-managed. Put that in there. Deposit source. Is it from you? Is it from investors? When do you want to complete? Exit strategy, like Tim talked about before. Mezzanine. Do you want a mezzanine loan? Anyone that you don't want us to approach, etc. So that's all goes there. You've then got your ownership tab, so it's more information on the shareholders. You put in here things like property experience. So I do have property experience. I've been a developer for 8 years and I've completed 4 developments. They're all residential. So all of this information goes in there. I've never worked in any of those professions and I have a degree. There you go. So that goes there. I then got my assets and liabilities, which I complete there. And then I complete my development appraisal. So the address goes in there if I put it in the previous section. But then I can break out my build costs. So that's all there if I want to, or I can just leave it as one lump there. So we pulled all this data through from search. If I want to change my term again, I can. And then I can put in my marketing costs, my agent's fees, my legal fees, etc., etc. At any stage, I can upload my own. The only thing I would say is if you upload your own, you don't then get the presentation that I'm about to show you. And then the final thing is the development schedule. So you put in your flats there, sorry, my houses, and again, you can upload your own. And what happens is once we get to this stage where these are all complete, that's ready to submit to lenders, okay? So we'll review it in the office. So request a review, we get a message, we check that we're happy with it. And then once we're happy, we'll normally call you and say, look, add a bit more detail about this, add a bit more, don't take that out. That's not something the lender wants to hear or see. And then once we're happy, it will get submitted to those lenders on the previous screen. So you can select up to 5, and that's what we call our deal forum. So those 5 lenders will be asked to submit their best terms on your deal. And then each one of those terms sheets will come back to you, and then you can make a decision which one you want to go ahead with. The other things you can add is detail here about your professional team, comparable properties. We talked about that already. There's a notes section there. If you want to make notes to us or to lender, then that can be done there. And then you've got all your supporting documents. So design and access statement, we talked about that earlier. Brochures, agent brochures of previous projects, that all goes in there. Site tour video, this is a really good one. It means that the lender has eyes on the ground, and it gives them a bit of an insight as to your plans with the property. I noticed, I think it was Darren in the chat talked about whether you can put in links for previous schemes, YouTube videos, all of that stuff can go in there, and that gives the lender access to your previous schemes. Anyway, once this comes to the lender, this is basically what they get. This is in test phase at the moment, so this is something about to be launched, and this is what the lender gets from us. And you'll be able to add your own logo here. So it won't say Brickflow, you can add your own logo. There will be a charge for that, by the way, probably a small amount each month to white label. But this is something you can take away, you can use with lenders, you can this with investors. And all the information that people need to know about you, about your project is all here. This is what a lender wants to see. This, for a lender, is a credit paper. They need to print this off and they go and put it on their credit committee's desk and say, I think we should lend to this person. That's how it should be done. Tim, anything you want to add? If you got this as a lender, would you be happy?
Yeah, totally. Yeah, so the best deals were well presented, and with all the information, even the cynical lenders that have a desire to write their own paper would still put that. They'd probably put a header and a footer and staple it together and pretend it was theirs. Yeah.
So the key thing here is that, if you want to stand out to a lender, that's the level of information that you need to go to, because that you're doing all their work for them. You've talked about the comps, talked about your team, you've given them the history on the planning, they know where your deposit's coming from, your A&L, your track record, it's all there. And that information gets stored in the platform as well. So, the things that are constant, like your track record, stay in the platform, so you don't need to complete that again. So complete it once, and then all you need to do each next time, put in the development appraisal, put in the schedule, and the details on that particular scheme, and that's it. You're ready to go again. I can complete that section of the platform in about 15-20 minutes if I've got all the information. So just to enhance your chances of success is actually quite a small amount of time. So this is the still versions of what we've just seen. So how to improve your chances. So whether you're using Brickflow or your own channels or direct, whatever you do not be scattergun. Do not do what we showed earlier on in the presentation, blind copy in 30 lenders and just send it to all of them, because they've seen that a million times and they're not going to respond well to that approach, and it does make you look desperate. So we speak to people sometimes and they've got 4 brokers looking at it. They're speaking to lenders themselves as well. And, for a lender, if they see 3 different people approaching them with the same deal, it in their mind, they start thinking, well, actually, this person doesn't really understand how the market works, because, you need one representative. They go and go round. If you're not happy, then you use somebody else. But, you engaging multiple people at the same time it doesn't do you any favors. Be honest and transparent. We've talked about that. So, do not try to hide anything. A well-prepared loan presentation, either your own or one of ours. Being organized. We've just done a deal for a first-time developer, and we're about to do one of our next webinars is with him, actually. And he's possibly one of the best organized people I've encountered in nearly 20 years in this business. So he, whilst he's first-time developer, he has 0 construction experience, and it's an absolutely stonking deal as well. He's sort of nearly 8 times his money. He's putting 175 in and getting 1.2 million out. Maybe it's not 8, is it? It's probably about 7.5 times his money. But he's QS that was appointed by the lender, completed his report in 4 days, and I've never seen that before. And it's because he was just so well organized. He handed over a data room, everything was indexed, and I mean that just buys so much credibility with the lender. We've seen people that are a lot more experienced than him, nowhere near as organized, and they don't get the red carpet treatment as that he got. Identify your weaknesses and address them. So if you're a builder, as Tim said earlier on, you probably haven't sold things to in market before. If this is one of your first schemes, you might not have much experience in planning. So think about these things. Could you buddy up with an estate agent or planning consultant or someone like that to bring more strength to your team? Similarly, if you're perhaps a property background, agency background, you can find sites, you can sell sites, but you don't have that construction experience. Can you buddy up with a project manager? Can you buddy up with a contractor? If you're coming with no experience sort of in property and you're coming into development for the first time, can you put people around you that will add to your team? Can they be part of the overall package? Can they be on profit shares, or can they be a figurehead of your company for the first couple of deals? Stress test your model. So show that you thought of micro and macro risks. I mean, there's a huge amount of macro risk at the moment. I mean, look what we've been through, COVID. Now we've got what's happening in Ukraine and Russia. These are things that it doesn't matter how much planning you've done, you'll never be able to factor this in. But what happens if GDVs fall? What happens if build costs rise? We talked about that as well. Benefits of being well prepared. So I mean, this is just on Brickflow, but in a competitive market, we've had a few examples recently. We had one of our colleagues, Matthew. There was 8 people bidding on a site, and he was able to write to the agent or prepare a letter for the agent that said that we'd done a search of the market and that there was 28 lenders that were prepared to support, and we could get a heads of terms from one of them within 4 hours if his offer was accepted. His offer got accepted. The other 7 people were cast aside because he was well prepared. He'd shown that he'd gone that distance of getting his finance or having those financial conversations early on, and that he could move quickly. And for a seller, that's great. So go that extra level. Certainty, speed of movement, speed of execution is really key in a competitive market. There is, as I'm sure everyone on the call has experienced, a lot of competition for any land site at the moment. So put yourself in the best possible position. And the bottom point there, best value. So best rates and efficient equity deployment. That's what the platform does each time, is it gives you, who's the best lender for this site based on your criteria, based on the project criteria. So a good example is what we've already looked at of a presentation. and we're coming to the end now. So this is hopefully what you've learned today about how we operate. These are lenders we work with. So as we said at the start, so I go back 37 today. I think they're all on there, Tim.
Well, if they're not, we apologise for the absences. It's a small slide, but we definitely have 37 lenders on board and more coming. Okay, good. These are some of the people that we've worked with so far, the money that they've saved. And these are based on offers they had when they came to us. So we were able to reduce their deposit each time by, as you can see, quite considerable amounts. I think that's quite a good point there from Terry, just to say presentation of information is key when assessing any new scheme for funding. So if you're on the webinar, we'll create a user area for you so you can try Brickflow out yourself if you haven't got one already. John will email you tomorrow with that. If you're a broker, please email john@brickflow.com to be added to the list for the broker pilot release. So that's going to be in April 2022. So next month. Tim and I were chatting about that earlier with our CTO. So that is slated for the end of April. It's going to be a limited release initially. So if you are a broker and you want to get on the list, then do email John. We'll also send you a webinar recording and a guide on building the best lender presentation. If you are that way inclined, then that QR code will take you directly to search. The other way of doing it is just tapping in @brickflow.com. And if you want to speak to me or anyone in the team, then you can do that by do that there. Have we got a survey? I think we have. I'll do the questions in the survey.
Yeah, should we launch the survey?
Yeah, let's come up.
Just launch the survey now. So if everyone could do that, that would be really useful. Gives us good feedback, lets us know what to do for you next time. Questions while we're dealing with that.
Somebody asked, why is a design and access statement important if it's already got planning? I think the point was it's important to see the importance of the design and access statement is that it gives you so much information about the scheme. It's added value. It's not, obviously it's not the planning consent. The planning consent is just the summary, but the design and access statement will tell you about location, it will tell you about your neighbours, it will tell you the planning, the drawings, etc. It's just a wealth of information, and information is key to any application.
Yeah, to completely agree with all that. It's more information about it. It's giving lenders eyes on your vision, which is very hard to do sometimes in a one-dimensional presentation. Christian earlier on said, what about having a strong team instead of experience?
Yeah, I think Christian, and welcome Christian. I think he put the message up, and within 30 seconds the next slide came up that says, if you haven't got experience, a strong team is
got you. Okay,
useful.
Yeah, strong team. So we've got 3 guys at the moment that are building 60 houses in the Midlands, and they've not done much at all personally, but lenders are happy to back them because 2 of them own a main contracting business and 1 of them is a QS and has been for a major house builder. Yeah, so whilst they haven't done much personally, you know, they're very well covered, or very well versed in construction. From Nemi, does the lender prefer it if the borrower is a limited company or a portfolio landlord developer?
The lender will almost invariably prefer you to be a limited company, and for that company to be a clean NewCo SPV. It wants to take a first charge. It wants to take a clean debenture. This can be a wholly owned subsidiary of your trading company. You've got no problem with that. It costs a couple of £100 to set it up. but they can ring fence it. There's no contagion with, you may want to be doing a development with one lender, you want to do a development with another lender. If it's in the same company name, it'll be a nightmare. So a new company for each deal is the preferred route for most lenders.
Yeah, I think we speak to people sometimes who get a bit tripped up on this, so they put all their land acquisitions in one company. The problem with that is then you can only really use one lender, and the problem with that is that you're then cross-collateralized across all your deals. So if one of those deals goes wrong, then effectively the lender can stop funding all of them. So as Tim said, they want a debenture. If you know, let's say you borrow from Lloyd's, and you've got 5 pieces of land in a scheme, and Lloyd's are only lending, in a company, and Lloyd's are only lending against one of the projects. A new lender that comes along, Barclays, to lend against site number 2, cannot take a debenture without Lloyd's permission. So then Lloyd's are in the driving seat. They can do all of those loans, or effectively they're your only option.
And it puts Lloyd's on notice that you're borrowing elsewhere, which might, not saying Lloyd's would be upset, but some lenders get upset about that. Why didn't you ask us? You know, it's nice to keep them playing off against each other.
Yeah, I think also as well, it's just you know, it puts them in the driving seat, doesn't it?
Well, they're concerned that when they lent you the money, you had all these assets. If you're suddenly borrowing from another lender, they're going, well, we haven't got the comfort that if there is a cost overrun, those assets may be now pledged to another lender for another deal. So we just keep it clean, keep it simple.
I'm coming at it more from like a borrowing perspective. You know,
Yeah.
the lender then doesn't have to offer you the best deal, right? Because they know you're stuck, right? You can't go to other lenders. And like I say, then all your assets are cross-collateralized. All your sites, if you're borrowing from one lender across multiple schemes and one goes wrong, they all go wrong basically, because the lender can just stop funding until you cure the first one, which could be, you know, catastrophic really across your business.
Interesting question there. CGIs, are they worth the money?
I think for bigger schemes, yes.
I think you'd probably put them in your planning as well. You start modelling it up. I don't think they're worth it for a single plot. And you might be doing, if you're an established developer and you will have a brand and you're trying to establish a brand across a region, brochures, CGIs coming soon, the billboards, the plastic hoardings, it's all brilliant stuff. I mean, people like Galliard Homes, you know, they're all about that advanced marketing. That's how they raise their money. They basically put up the flag, we're coming soon, sell off plan, and you've got to have CGIs, adverts, artist impressions, call it what you like, to sell off plan. And I think that selling off plan, you may think you're taking a hit, but if you're guaranteeing sales, if you're taking deposits, if you're taking exchanges, your lender's going to be right up there supporting you, because they know there's no hanging about once they're built.
You'll actually get greater leverage as well.
So
we were working on a scheme in East London where 40-50% of the scheme was pre-sold, and lenders were happy to lend a much higher percentage of those pre-sales. So we had a higher blended average. So they were lending, I think, at 65% across the scheme, but they were happy at GDV. They're happy to lend 75% of GDV on the ones that had already sold. Yeah. So it just brought the overall average up. So yeah, it's a good thing for bigger schemes, definitely. But CGIs, I mean, I think they're great. You know, I think they really tell a story.
I'm a watercolor man.
Watercolor. Yeah, cool.
But yeah, I mean, Darren made a good point. If the market's dropping, a pre-sale with an exchange contract holds your price.
Yeah, 100%. Yeah. And I think Darren said as well about the social proof. Prospective borrowers experience documents shown in social media. Mm-hmm. Yeah, I mean, you can add it into the platform, but yes, absolutely, like that's something that you should be showcasing, and you should be proud of it as a developer. Like it is your provenance, it's your portfolio, isn't it? It's like if you're you're an artist or photographer and somebody says, what have you done previously? They have a really nicely presented portfolio of work, yet developers don't seem to do that. It's just strange. Some do, obviously, but a lot of them, when you ask for sort of track record, what have you done before, is kind of a one page of A4, and it's like, you've done some amazing stuff here. Why not showcase it?
I've seen developers walk into my banks with a handful of brochures, sales brochures from their previous developments. They've kept one of each, and give this to your credit team. This is what we do. There was a point we missed from Christian earlier, which was modern methods of construction, MMC. What are the lenders' reactions to MMC? And I did it is one of the questions we ask. We call it modular. I think the lenders are very nervous about modern methods of construction because most of it is built in a factory off-site. They can't touch it, they can't feel it, and yet that's a lot of money going out in that advance payments. And more than 50% of our lenders are reluctant to make advance payments unless they can touch it and feel it. Traditional lenders wouldn't lend, even if you had a pile of bricks on the site, they won't lend, even if it's delivered but not fixed down. So to get them to pay up front for a modular build, very, very difficult. The ones that do it really well. They go for the vesting certificates. They might get a guarantee from the modular contractor, but they don't want to fund stuff built in Poland. It's got to be a UK manufacturer. I always say it's taken the banking world 30 years to get used to funding timber frame. That took forever. And now we've gone one step further. Modular is just a better version, but it's still very, very difficult to get funding for modular.
Yeah, there are a couple of lenders actually on the platform that do it, as Tim said, really well, and actually have funded construction which has been come out of Poland and Eastern Europe, but also China. There was one lender I remember saying that everything came from China on a boat. And they were happy to do that. I think ultimately it comes down to the strength of the modular construction business. Like if they've been around for a long time and they're a big business, then I think lenders will be more willing to take the risk. But it also comes down to the profile of the developer. If you've got a strong asset base, so if things do go wrong, you can afford to cure it. Then I think lenders are going to take a bit more of a risk-based approach. I think also as well, if you own the land outright, that's obviously going to help. If you need a land loan on day one, it's difficult for a lender to do that when they're having to fund a huge amount of build costs before it's being delivered to site, because ultimately that money is effectively being levered against the land, which hasn't. Normally, when you're lending against land as build costs, it's increasing in value. So every slug that's going out is because value's been added. With modular, no value's been added. You're being asked to pay 50% of build cost for things to be assembled off-site, but actually nothing is being valued. The site is still worth what it was at the start. So that's the challenge.
But yeah, that's exactly what some of the lenders are saying. So if they want an advance payment, we'll do it as a land loan. But if you're already borrowing a land loan, you can't have it twice. Jonathan Fish has asked a question which is very, very difficult. What's the minimum pound per square foot construction cost lenders are now working from? It's £100 a square foot. We used to say 5 years ago, £100 a square foot can't be done unless you're in North Norfolk. I know it was a bit tongue in cheek, but £100 a square foot, it's a regional thing. Labour costs are regional. If it was 100, is it now 130? Probably yes, but if it was 130, it's now 160. London, you wouldn't be doing for less than 180, 250. If it's high end, you wouldn't be doing it for less than 300. So you can't actually say it's a set pound per square foot for everything. It's whatever the product is, it's regional, and it's the finish. Are you doing it to rent? Are you doing it for sale? Different finish. And as for a 5% contingency, we put 7.5 as a minimum in the platform. Our lenders are saying that in these uncertain times with rampant inflation in materials and labour, 10% more likely than 5%.
I've had two quotes for different projects where lenders have come back and said we want 10%, and that's not, you know, them. That's standard policy. It was nothing to do with the project. It's just that's what we're asking for now. We've put 7.5 in as a minimum. We do still see people trying to put 5% in. It just won't wash really with a lender. But then we did some, going back to your North Norfolk, we're doing some barn conversions in North Norfolk, and the lender wants to see normally for those 15 to 20% contingency, because there's a lot more unknowns, and they're definitely not £100 a foot.
No.
Barn conversions are
notorious,
expensive. Yeah, I think I remember speaking to a valuer pre-COVID, a national valuer, and they were saying they'd work on £90 to £120 a foot for white box basically, and then everything on top of that, then they would add finishing, but that was for everything outside of London and the home counties. They said London home counties it would tend to be, you know, 120 to 150, and then London it was between 200 and 300 to white box and then finish on top. So
yeah, and that's a very good point. As a lender, people used to say to me, oh, it's £120 a square foot. I went, that's a bit cheap. So, well, it doesn't include the garage. It doesn't include this. It doesn't include that. Well, let's get it all in there. Then we've got a better figure. And I want to build it up. I don't want to be putting things up to credit and they go, no, you can't do that now. Because our QSs, the monitoring surveyors of the lenders, they have benchmarks. And if the benchmark is way over, they normally carry out their reports and they say, look, this guy is an owner developer, he's doing it at cost, he could probably do it for £100 a square foot, but if it went wrong and the bank had to appoint its own contractor, there's no way you'll get anybody in to do it for that. So therefore the lender wants to know what it would cost the lender to put a contractor in. We're at £130 a square foot. That's what they will lend you, and because they'll lend you, they would have to lend or set aside more for the development cost. That would mean you would get less towards the land cost, because they always want to fund 100% of the build cost, and they'll fund whatever they think is what expected and what their monitoring surveyor has told them was a realistic figure.
Yeah, I think I've got something at the moment which is 140 a foot for, you know, pretty bog standard starter home stock, you know, sort of 250 to 350 price points, 3 and 4 bed houses, and lenders are saying, you know, that looks a little bit light perhaps. That's in the Midlands. So yeah, I mean 130 is probably the new normal, going back to Jonathan's point, I think. There was a question about swap rates from LinkedIn. What have swap rates been doing? Swap rates are generally up, but most lenders won't fund off swaps. That's the regular mortgage market. Development lenders are generally funding over SONIA, which is what used to be LIBOR, or they're funding off their own internal rate. I think there are 7 lenders that fund off base rate on Brickflow. So that will be passed on immediately. So will SONIA, although most of the SONIA lenders, so again, that's on the platform. You can check eligibility and see all of that information on the platform. The SONIA lenders tend to have a floor, which was set at 0.75 previous to the recent rate rises. And some it was 1, so you might not see much change on those for existing loans at the moment. But then the other way of doing it is the lender off their own internal rate, and that is completely at the lender's behest as to how they price that, which is a risk. But what we've seen so far is most of these guys are not following up at the level that the Bank of England is. They're doing it at a lower level, and I think that's good to see, because I think if lenders do just pass on the full amount each time, where as rates go up, they're going to become uncompetitive, and sites are going to become even more difficult to sort of make work.
Yeah,
so,
we've got lenders lending 6 over base, 7 over base, and then and base is 0.5. And as Ian said, with the
0.75.
floor, they might have a floor of 0.75. But I've got one lender that's lending off a base of 2.1, but their margin is only 4, so they're still only 6.1, which is a really good rate. But their cost of funds is they've put in at 2.1. It's an arbitrary figure, which and as I say, some of the lenders we speak to say as long as the all-in rate is X, that's what you've got to look at. And a number of our lenders, majority of our lenders, say that if the rate they quote you when they give you indicative or credit approved terms is the rate that applies to your loan, full stop. The ones over base, 7 base rate lenders, it will go up. That's 7 out of 37 will go up if base rate goes. Majority are fixed for the term of that loan. So that's all good news.
In terms of rates, I mean, to give you an indication, we had one yesterday approved, which is 3.7 over base. So total pay rate of 4.45 for a development loan. So, it admittedly is not a huge amount of leverage there. We're about 55%, 50% loan to GDV.
Yeah.
But it's, I mean, very, very cheap money. But strong borrower, good scheme, good profit. But yeah, 3.7 over base. It's pretty good. Is that all of our? I think that's covered.
That's all our questions. Yeah, I think we've kept these people waiting long enough.
Okay, great. Well, listen, thanks everyone for joining. If you do need us, pick up the phone or just drop any of us an email. I'm Ian at Brickflow. That's Tim at Brickflow. We can pick up any of your inquiries. John's putting it in the chat. Great, guys. Thank you, everyone. We will have we've got another one coming up in about 3 weeks, and that's actually with the chap I mentioned before, the first-time developer. So we're going to go through how he put that scheme together. So look forward to that. Cheers.
Thank you all for listening, and we are delighted that you all spent the time tonight listening. Thank you very much.